The broadcast is now starting. All attendees are in listen-only mode.
Well, good evening, ladies and gentlemen, and welcome. Nice to have you with us. Oh my goodness, we've got Terry with us today. Hello, old mate. Thank you for being with us. The sound, Terry says, I think he's going to say the sound is okay. Yes, he said, can hear you fine. That's great to have you with us, mate, and everyone else too. All our old friends are here, of course. We have a terrifically loyal following, which I very much appreciate. So let's see what else we've got, of course. I have to say it's good morning to our friends in Australia and good afternoon to our friends in New Zealand. Let's have a look at another beautiful day. Great stuff, folks. Listen, you wouldn't believe it. It's autumn down in the southern hemisphere and cold and shivery in New Zealand. Beautiful at Queensland's Gold Coast. Sunny, bright. We went to New Zealand some years ago. My wife's very elderly parents live there, and we went for 3 months to give them a hand with some issues they were having, old age. It's coming to all of us, I guess. And we finished up staying for 13 years, and beautiful place, God's country. But boy, oh boy, the winters. And I know a lot of you folks, we have a lot of clients in Canada and parts of America. They're very, very cold there. So good luck to you. Okay, Adrian, you're with us. You're going to do a tutorial next month. Good to have you with us. Akhtar, he's a old, long standing client of ours. He's done a couple of tutorials. Alan, Albert, been with us for years and years, and Alex is back here with us. Bernard, how lovely to hear from you up there. I know it's warm and sunny where you are, mate, with beautiful weather, and great to have you and your pal with us. And gosh, I guess you've been one of our longest members with us. Good to have you here, my friend. Haven't heard from you for a long time. Daryl in Mossman, hope things are sorting themselves out over there for you, mate. Donnie Maydell up in Canada. Pete over in Auckland, yeah. Cold in Auckland, eh? Yeah, it is, mate. Pete and his buddy took us out on their beautiful 42-foot cruiser when we were having the last Waiheke tutorial. They took us around Auckland Harbour, and we had a splendid lunch and moored off by the peninsula there. And yeah, they were most gracious, and really enjoyed their company. Good folks to have a beer with afterwards too. That was Phil. Yeah, that's right. Phil was your mate. Yeah, haven't seen you guys for a while. And they're very good guys to have a beer with on a hot day, which is important, of course. That's great. Let's see. Oh, gosh, we've got so many today. Thanks for being with us, folks. Gary. Harold, the gold bug from Reading. Hope you're well, Harold. Terrific to have you. The lovely Janet. I hope your ankle's healing, Janet. You should be back on your feet by now. Time we spoke. John Chiwa, you new one. I'd like to have you with us, John. John L. down in Coffs Harbour. He's done a Daniel Code tutorial. He's got the makings of a very, very fine trader. Oh, look, everyone's here. Mark Lutz over in the States. Mark, I'm going to have you on the show in a couple of weeks, and maybe another couple of guys who've done tutorials, so you can talk about it. Maddie down there, Maddie the Big C down there in Melbourne. Good to have you with us, old mate. Marilyn, lovely to have Marilyn with us. She's in the middle of doing a tutorial. We didn't do any work this week, Marilyn. We have to catch up next week. You let me know when it suits you. We need to just keep tramping along with the business of teaching you the good stuff. Michael's with us. Michael Pell, he's a tutorial guy from, not sure quite where Michael is, but he's lived in Panama at times. He's all over the place. He was in Perth last I heard of you. Good to have you with us, old fella. Mike Murphy, he's a tutorial guy. We need to talk with you, mate. Norbert, who's left the west coast of America, gone back to Canada. We need to talk with you, Norbert. Catch up with all these people. Look, there's Pierre. Pierre, hope you made your trip to Las Vegas all right, mate, and it's well overdue for you and I to be talking and continuing your tutorial as well. Richard and Rob H from New Zealand, old mate of mine, great trader. Terrific analyst, good insights. Lots of others with us. Great to have you here, folks. Tom, who I've described in the past as a broker, and his partner tells me they're not brokers, they're wealth managers, and they're very important people. Toddy Timmons over there in Southern California, and Bill Ford has been with us for years and years, and of course Vladimir Putin. There's always one, but it's good to have you, Vladimir. We need the obligatory Russians with us. Okay, let's see what have we got here. Adrian, yes, hello to you. Albert, I want to ask: is anyone in Florida that trades the Daniel Code that I could meet up with? Well, probably. I know that Tom is down in Florida. He might like to talk to you. I'll pass that on. Tom, I know you're with us. One of our clients, Allard, has been interested in the Daniel Code. He'd like to meet up with someone. He's in Fort Lauderdale. He's new to the Daniel Code, and thank you, Terry. Would like to talk to someone in Florida about it. I don't know how far away you guys are, but let me know if you would. Yes, Norbert, good. Sent me a spreadsheet. Right, great. Akhtar, yes. Akhtar would like to talk to a DC member. Where are you? Akhtar, you're in India, aren't you? I don't think we have many members in India. We've had a few goes at India. He's in Florida. Of course you are. I'm thinking of a different Akhtar. I do apologise. Yes, well, we probably need to have a little Daniel Code club for all you guys to get together and talk to Tallahassee, Florida. We'll see what we can do for you guys. Anyway, let's move on. Great to have you with us. I wonder where Sue is today. We don't seem to have many of the ladies with us. Okay, they're obviously got a better offer, eh? Anyway, folks, welcome. Thank you to Terry for this marvelous picture that we're using here. And as you can see, it's the four horsemen of the apocalypse. And one was white and one was red, which, the cognoscenti would call a chestnut. One was black and the other was a pale horse. And Terry's captured them all for us here. And the four horsemen all comes out of Revelations if you want to know more about it, and they're bringers, they're harbingers of doom and war and bad things, and of course to us as future traders that's exciting because they bring with them panic and chaos, and we love chaos. Chaos increases volatility, which is the fuel that makes our trading so great. Lots to talk about today, folks, so let's get moving here. Type any questions or comments you have, please, into the questions box, excuse me, which I'll deal with before the day is over. Let's see here. Bear with me for a moment. Great, thanks for that, Terry. Okay, so this page should have changed, and I've headed this, are we there yet, Mummy? You know, those of you who have children certainly remember with young children, you're taking a road trip. It's, are we there yet, Mummy? Are we there yet, Mummy? And, as these equity markets just go on and on and on, grinding their way up and grinding their way up, that's the question being asked more and more. Are we there yet, Mummy? Part of what you actually see in markets is emotion, and emotion can get pretty silly. And I want to talk to you today about some of the things I'm seeing that are particularly silly. For those of you that didn't know, Friday is going to be International Whores Day. So I don't think we have any whores with us that I'm aware of. Would certainly spice things up a bit if we had a dozen or so. But congratulations to them, and for you taxpayers like me, you can be thankful that the United Nations is spending your money so well by putting on a recognition of International Whores Day on Friday. Big flashing news today. Donald Trump's pulled the US out of the Paris Climate Change Agreement. The press is in uproar about that, typically the liberal media. The theme of what I want to talk to you today about is balance. There's almost always two sides to a story. I've been an attorney for, believe it or not, 49 years. In fact, I'm wrong. I tell a lie. This year will be 51 years. And excuse me, if you've been an attorney, you spend your life dealing with people, all sorts of people. You generally start off like I did at the bottom of the ladder, and you deal with domestic disputes and small criminal matters and traffic matters, and then as you progress up the ranks, you get into the more sophisticated types of law, the corporate stuff, the takeover stuff, tax, all the stuff that earns the big dollars. But in that, excuse me, in the process of that journey, you meet all sorts of people. And one of the things you learn is that there's usually another side to a story. What you hear isn't all right and usually not all wrong. But what we seem to be getting to now is peak differences. This is, embodied so clearly in the political scene in the US and the UK in particular, where the left and the right are so divided. There's acrimony, there's hate, there's bitterness, there's rage. And honestly, I don't understand what it's all about. I mean, I understand what they say, but I simply don't understand the passion. And as you get older, of course, you realize that you can have your argument just as well without a lot of the nonsense that goes on, particularly in the US media. But this whole climate change issue has got to be something that you have to think about as a responsible person. And there are two ways to think about it. Basically, the argument, if you accept what's called the settled science, which is not settled at all, is that global warming can be attributed to man-made activities. Then you're anxious to cease the use of carbon-based fuels, fossil fuels, oil, and coal in particular. And you're anxious to get switched over to renewable energy sources. And they would be things like wind and solar and also all the other things that are coming. And, there's a lot of merit in that. You can't help but look at, go to Asia, go to China and have a look at what's coming out of those factories that have got no pollution regulations. If you see the chimneys just churning away day and night, you can't help but believe that there's a better way of doing that. On the other extreme is Peoples, as Michael Peels just sent me, saying climate change is a total hoax. And as I hope you've got the message that I don't believe this science is settled, but I do believe that one extreme or the other is a real problem. If you look at what's come out of the Paris Agreement, if you look at the basis of that, it's an attempt to bring countries in very different stages of industrial development together to have a framework of an agreement. And it involves such things as giving the less industrialized countries, front page examples, of course, are Russia and China, a carte blanche to go on with high levels of emission as they try to catch up with the development in the more developed countries, commercially, industrially developed countries, US and Britain, etc. And the price of that is reductions in limitations, at least net effective reductions in oil exploration and production, and coal mining and use and production. And there's a good example of what happens if you go too far the other way. In South Australia, which is one of the states in Australia, they've had a very leftist, liberal, most Americans use the expression liberal. It's a bit au contraire here because here the liberal government is the conservative or right-wing government, and Labor is the left-wing party, but you'll get the message that I mean. South Australia's had a succession of very liberal left-wing governments, and they've jumped the shark on renewables. They've got something approaching 46% of their energy coming from renewables, primarily wind. And of course, the limitation with that is it's pretty effective when the wind blows, but the wind doesn't blow all the time. And the wind tends to die down at night. And we don't yet have effective means of storing electricity product to put it into the grid later. So in South Australia, we've had mass blackouts. We've had them on an industrial scale. We've had huge industrial complexes like BHP, British Broken Hill Proprietary, having slag, molten steel, just cooling off in its smelters and ruining the whole smelters. Cost millions and millions of dollars to repair that. The other end of Australia, we've got a Indian coal company called Adani that's trying to get approval to build the world's largest open cut coal mine. It covers about 40 miles of open pit mining in central Queensland. And this is where the issue comes down to environmental jobs. North Queensland, which is the state I live in, it's a huge state. It's equivalent, I guess, to the Texas of Australia. Changes from a tourist coastal emphasis in the south of Queensland, where I live, into vast open expanses in north and far north Queensland. And the employment rate there is dreadful. It's diabolical. It was built up largely on the mining boom, which has now died. You've got unemployment 2 and 3 times the national averages, 11, 12, 14, as much as 16 and 18% in some of those North Queensland towns. And this is a huge project that offers very, very significant employment. So most politicians Queensland politicians at least, are trying to support it. The Queensland government's all for it. The Commonwealth or federal government, which has significant weaknesses in its representation in this part of the country, is offering to put in $1 billion, that's with a B, of loans to help them build a railway, because they've got to get this coal 400 kilometres, 300 odd miles from where they're going to mine it to a port that's not yet been built. And the port, of course, is right next to the Great Barrier Reef, one of the marvels of the world, with all the environmental risk of the damage that could be done to the Great Barrier Reef. Most sensational place, one of the most sensational places I've ever seen, folks. If you ever get a chance to get to Australia, get yourself out to the Great Barrier Reef. It's really a sight to behold. There's a conflict, and you can put this whole Adani story in the context that banks won't fund it. They don't see it as sufficiently commercial. They see the risk on it as too high. So why would government get involved in funding something of this nature? And of course, it's just really a question of balance for politicians, whether they see a personal benefit or not. Develop this concept a bit more, and we talk about the Paris Accords, pollution in general. Have a look what's happened with Volkswagen and its diesel defeat devices. I'm sure you all know about that, but if you don't, Volkswagen, one of the largest car manufacturers in the world, pushing diesel cars, trying to meet EU and US emission standards. A whole lot of marketing and hype about how they've done that with their sophisticated new clean diesel engines. Turned out to be rubbish. What in fact they'd done is they'd fitted a IT type device on it that put the engine into a different mode when it was being tested for emissions. And they rolled along that way. In other words, they gamed the system. More than gamed the system, they entered into criminal activity to mislead the whole world. Honestly, the consequences of it have been, in terms of a company that size, not that much. There's been no criminal convictions, no criminal proceedings I'm aware of. Very, very substantial fines, which doesn't matter to a company that size in the long term. These sort of extremes of one side or the other on this climate change business are both have bad consequences. And what you should be pushing if you're talking to folks about this is balance and commercial reality. We're getting these wind turbines jumping up all over Australia, hideous things they are, but very, very efficient in terms of harnessing the wind, turning it into electricity. But here's the point. They are totally uneconomic commercially. And the subsidies that are given to the people who make these machines, mainly in China, and then run them are staggering. And who pays those subsidies? Well, the government, which means you and I as taxpayers. And as you see, as I put at the bottom of this particular page, government funding always means social objectives. And that scares me. Governments have an appalling record of making choices. And when they start using taxpayers' money to pursue their particular social policy, you can bet it's going to go wrong. Yeah, quite right. Michael's saying there's the gaming of the system. The people who are collecting the money, the subsidies, are not you and I. All we're doing is paying the cost. So balance in all things. I talked today about in this invitation to come and join me today about bubbles. And this page, which has changed for you by now, says bubble, bubble, toil and trouble, the old mantra of the witches. And truly we've got to the stage that bubbles are everywhere. And what it really is, folks, it's inflation. It's asset inflation. And we're not seeing a great deal of inflation in CPI, Consumer Price Index, those types of measures. And there are two reasons for that. One is that the measuring, which is done by government, is fixed. It's rigged. Real inflation in domestic household expenditure is still running at about 14%, but the official figures have it around 2%. And the reason for that is that they just simply peel off the really dynamic elements that have big price volatility. And like many other government measures, I mean, I'm not a conspiracy theorist all the time, but I'm certainly very, very skeptical of government figures. And they're provided for two purposes. One, because they're trying to record and measure important things that are important to the economy and businesses and people. But they're also massaged to account for policy and what the government wants you to believe. So I saw a interesting article today. One of the problems with all media, whether it's writing or television or radio, is that the space is very crowded. There are so many people writing commentary. There are so many people talking about it, social commentary, business commentary, on everything, that the space is very crowded. And to be heard, you have to do something extreme. What Kathy Griffith did in the States this week with, the severed head of Donald Trump is a prime example of that. They have to be so extreme as to draw attention to themselves. And these are people who are totally irresponsible and have no social conscience, but that's not their business. Their business is to promote themselves. And unfortunately, we have more and more shameless self-promoters in our population. But instead of being scorned, as they were half a generation ago, they're lauded, they're applauded, they're everywhere. Social media loves that and magnifies it. So you look at these bubbles. China, we've been hearing about this for years and years and years, that their debt to equity ratio has gone mad. And it's now over 300 to 1. Their shadow banking sector is the one that's got the big question marks about it. Yet, have a look at the situation in Japan. I can remember when the international debt to GDP ratio, which is a slightly different measure, but it's telling you the same thing in Japan, was about 140%. And the world's fears were, this is going to get to 200%. And when that happens, it's Armageddon. Well, No, it's now over 600 to 1. And Japan is still, one of the 2 or 3 best international countries in their credit rating. So the point to remember is that we've got bubbles everywhere. We've got bubbles in motor vehicle prices, in housing prices, in stock market prices. But bubbles and bull markets can go on for much longer than you can remain solvent. So don't be shorting anything at the moment, but be thinking about what I'm trying to get across to you in this webinar. And despite a few stupid comments that I've received, what I'm trying to say to you today is it's the time to become nimble. For those of you who've got big stock portfolios, be very, very cautious. You don't know how quickly you can get out of them. For those of you who are managing your own portfolios, you have your own fate in your own hands as the way it should be. For those of you who are invested with fund managers, with all those sorts of things where you don't have direct control of your investments, I really urge you to start thinking about shortening up your investment time frame horizon. And the great thing about futures is it's incredibly quick and nimble. You can be long the day after you're short. You can be short and you can be long with a high degree of immediacy. And you can't always do that in stock markets, particularly with single stocks. You can't short them. You have to go and borrow the script from someone. You have to find that someone to lend you the script. You have to pay a fee for it. In other words, it's designed to be as hard as is possible. So you don't have that flexibility. And remember, exciting as this bull market's been, there will inevitably be a bear market. And the great thing about futures is you make as much money with the market going down as you do when the market's going up. And the buy and hold, the legion of buy and hold stock people who are invested in stocks, they're turning their back on the best trading opportunities in the world. With futures and with Forex, you can trade both ways and you get paid exactly the same going down as you got paid going up. But I really do think there are some warning signs on the horizon now, and it's time to be nimble. You should have got another change of screen by now. And this one's headed, "Stock market investments are dangerous." And I got this comment today from Zero Hedge, which I enjoy. It's very informed. It's very switched on. It's quite riotous at times, and I do read them every day, and sometimes they prompt me into thoughts. This was an interesting one today about the fallacy of this buy and hold, and it quotes an email from a guy to a well-known guy who does commentary for them, and the email says, "Explain this to me. I've been listening to all these great people on television talking about how great the market is doing. However, my advisor convinced me back in 1998 to buy a bunch of blue chip stocks and just hold them. Well, almost 20 years later, I'm not much better off than where I started. I'm still a long way from where I need to retire. I just don't get it." And the commentary goes on to say, this whole purpose of this stock market buy and hold mantra, in my view, is nothing short of fraud. And I've given you this view before, that these indices that always go up from left to right, almost always, the predominant time, better than 80% perhaps, partially they're engineered. These indices don't stay the same. Bad stocks that fail and poorly performing stocks, they're removed from the indexes when they're rebalanced, usually every quarter. So when you see an index now and compare it to something years ago, it's not the same. The components have changed because they're constantly being updated. And if you keep, taking out the duds and bringing in the new hot young thing, you keep enhancing the performance. Now, that's by no means the whole story, and I don't suggest it is, but it's a significant part of the story. And the point that I want to make to you is the second paragraph, which says when you're invested in any asset that can lose principal value during your investment time horizon, you cannot compound returns. Compound returns only occur in investments, do not lose principal. I know there's a semantic technical argument around there, because what you're actually losing is time. So you look at the 2007-2009 crash, how long the market took to get back to where it was, and now look, it's way above it. That's fine. But look at the years that it spent before it got back to where it was, and that's what you've lost. Investing in stocks and shares is essentially a lazy man's game. It's designed to part people from their money and put it in the hands of people who are supposedly experts and who are going to charge you fees for what they do. The reality is that most of them aren't experts, and if you follow this argument of why all these major pension funds, that's a bit of hyperbole, most or many of the major pension funds around the world are so underfunded, it's simply because they set a target that they expected to get in their returns, and they haven't got it on a consistent basis. That's an ongoing real problem. Chicago today, the state of Illinois downgraded by S&P and Moody's. Why? Well, their pensions are underfunded by hundreds and hundreds of millions of dollars, and they just don't get the returns that they expect to get. So my question today, we've gone through peak oil, we've gone through the end of the world with Y2K and peak this and peak that, and the question today I want to poke to you is, are we arriving at peak stupidity? And at the top of this particular page, you can see something that somebody whose email name is Spindrift sent to me today, and it says, lol, lol, loo. I have no idea what any of that means. I mean, my children told me it stands for laugh out loud. New highs in US indices, all sentiment screams, buy what you can. You telling somewhat of horses. So this is a typical idiot. Fortunately, we do have a few of them. And he hasn't taken time to read the invitation, which talks about a time of being aware and of trying to adopt an attitude of being nimble in your investments and prepared for anything. And then occasionally we get idiots like this. We used to have a whole lot of them. Sage made an interesting comment how quiet forum is these days. At the early days, of course, we've been doing this for many years now, but when we first started off the Daniel Code, we had a big heap of these idiots. And they tend to be people with short attention spans. And yeah, Michael, you're quite right. Idiots provide entertainment. So are we approaching peak stupidity? I think we probably are. I had a really interesting article today that I wanted to share with you. And it's about a company, American company called Restoration Hardware. Its ticker is RH, and I fell over laughing about its the comments with its release of results, which were dreadful, way below expectations. And this is something from the chairman, and he said, yet our most valuable asset is not what we've done, but rather who we've become. We have become a team of people. We've become a team of people who don't know what can't be done. A team that is driven by our values and beliefs. A team that is willing to march into hell, as we did last year, for a heavenly cause. I mean, please spare me. This goes on to say, we plan to reduce our new gallery opening cadence to a range of 3 to 5 a month. In case you don't understand what he's talking about, and I'm not surprised if you don't, he's just talking about the number of new stores they're planning on opening. What's wrong with saying reduce our store opening? But no, we've got to have our new gallery opening cadence. I mean, this kid's dreaming. And he signs off his letter, Diem Carpe, for those of you, just to show you he knows a bit of Latin. Those of you who haven't been forced to do Latin, those of you who are maths and engineers and science guys, it means seize the day. Those of us who were forced to do Latin as schoolboys, unfortunately, still remember some of that stuff. But this is a public company. This is a company, incidentally, Its price went from $25 to $50 a share in 3 months. So what's it worth? Is it worth $25 or is it worth $50? Or is it somewhere in between? I mean, this is a bricks and mortar type company that sells hardware and restores all sorts of antiques and stuff. I mean, if that's what the market's telling you about valuations, you've got to be very, very suspicious about whether they're either A, real, or B, mean anything. Have a look at this on the next page. Uber reported yesterday its net loss totaled more than 700 million last quarter, despite pulling in 3.4 billion in revenue. Okay, so the net loss 700 million. It's a stock that's valued at 70 billion. Over the last 12 months, Netflix burnt through 1.7 billion in cash. Stock market says it's worth 70 billion. Snapchat, this is a fabulous story, debuted with a $30 billion valuation after its IPO, only to subsequently report they'd lost 2.2 billion in the previous quarter. But I mean, if you read their prospectus, these guys say, well, we're not profitable, and what's more, we may never be profitable. And the shares which they priced for the IPO at 17 went off at $23 to $24. I mean, it's just crazy. And of course, this is hope. This is peak hope combined with peak stupidity. They go on. Telecom company Sprint still somewhere north of 30 billion, despite having lost 40 billion in debt and burning through more than 6 billion over the last 3 years. And then there's Twitter, a rudderless, profitless company that's still worth over 13 billion. All that's from Zero Hedge. I thank them. And the final comment from a very respected analyst: Uber is a one-of-a-kind company in good ways and bad ways. It's going to be a case study. This is a cash-burning machine. So just get your head around that. These are some of the really, really big movers in the indices. The other big movers are, really profitable quality companies. You look at the Google, you look at the Microsoft. Then you look at these new technology companies. They have got an enormous valuation on them. This is where the shareholders' money is. Snapchat really is just proof that if you have a product that's trendy, it's known to the great unwashed out there, they'll not only buy it, they'll pay stupid prices for it. But where's their return? I mean, this is the company, their own directors say this may never make a profit. And it's hard to see a pathway to profit for a lot of these. Uber is now facing all sorts of competition that you don't hear much about. But $70 billion after that loss. I mean, I don't get it. But don't let that put you off, folks, because there's lots and lots of things that I don't get. I say to my wife quite often, I want to talk to you about something. I don't get this. And she says to me, John, there's a lot of things you don't get. Right, let's move on here. Now, folks, get your attention onto this. This is a chart from Freddie Mac, and this is a chart of the percentage share of mortgage refinances that involve a borrower taking cash out of the home quarterly. Have a little look in here. Here's 1998, moving up. Here's the 2000. This is the dot-com crash going up here. See how it's rising? Here's the 2007, top of the big 2007 bull market, rising, and look what's happening now. Okay, this has at least got to make you think of the mindset. Asset valuations are high. People are adding to their mortgage. It's no smart way of financial engineering, but they're adding to their mortgage and having substantial, large amounts of cash outs. In other words, they're very highly confident. They may have liquidity problems, and this is a pattern that, to me, is starting to look ominous. Let's move on to the next chart, which will give you another idea. This could be the big canary. A lot of comment lately about US domestic car sales. Just put your mind back here with me as I'll try and give you a mark. This high here, I'll just get the tool if I can. I'm not sure that it even works. on this page. Yes, it does. Here, put your eyes on this. 2000. Here's a peak. This is late 2000, just after the crash, and down it goes. Have a look what happens through here. We get, this is 2005, 2006, 2007. This is the high of the 2007 bull market, and you're seeing a lower high. Look what we've got now. A lower high. Okay. This is one of the real canaries because it's so easy for people to buy new cars. 6 months drop greater than 7%. I don't know that that's so significant in real terms, but I think what is significant is this repeat pattern that these markets have a peak. Here's the actual, this is 2000 over here. It's in this first box here, which is right here on this chart. And you can see the markets pull back and it's now making a lower high. You can see the same thing happens here. There's 2005, this is 2007 in here. It's sitting on a lower high. And right now, for the first time, what we have is a lower high. And I do think this is a canary. I think you can add this to the debt bubbles. You can add this to what we've seen in the cash out refi on the housing market. And you will know very well that the housing markets in selected places are totally and utterly ridiculous. Now, this housing bubble is a little more complex because it's very much regional. You see in Australia, Sydney, the biggest city, has had an 18.5% increase in housing prices year on year. That's 1 year. Melbourne, about 9 or 10% year on year. The other major cities, nothing like that. The next biggest city, Brisbane, plus 2.5%. So you can see it's very, very location specific. And you're seeing the same things in the US, in the more desirable places to live, and in particular where work is. That's the big draw. In Australia, where we have the highest official immigration input in the world, that's very much the driver. That's where people go, where the work is. Okay, so we're still going. I hope you're enjoying this, folks. Some guy called Imran Pasha has left, which I guess is nice. And he said, please get on with the subject you've been rambling on about. So I hope you don't think I'm rambling. Feel free to insult me if you like to. Just type your comments and questions, please, folks. I'm trying to get across a total picture for you. Here's the quick snapshot of the property. You've actually seen this before. Albert, I've got your comment. Thank you. I'll come back to you on that. This is just to highlight what we've been talking about with property. Crazy stuff. When you find these sort of better places where, you'd probably like to live yourself, and when you look at houses and your estimate is about half the asking price, you just shake your head. It's extraordinary, and that's what we're seeing now. We've seen it all before. There's nothing new about this. And those of you who've been with us a long time know I've been arguing for a long time that this the median house price as a multiple of income has been a complete fake, and I've shown you this chart before. Have a look at it. Sydney, 12.2 times income. Vancouver, just about 12. Auckland, New Zealand, 10. San Jose, Melbourne, Australia, Honolulu, Los Angeles, all these desirable places. Look at these multiples. How is it so? Women in the workforce is a big part of it. Most families now are dual income families. They have to be. You look at these numbers, you can't go to the bank and say my house I'm buying is 12 times my income. But even so, it's quite staggering, and I think something to keep your eye on. Free trials, folks. If you don't already have a trial at the Daniel Code, please feel free to help yourself. There's a banner at the top of the landing page at www.thedanielcode.com. Just click on that banner, follow the prompts, and you will get a free trial of everything at the website for 31 days with our compliments. And If you have any problems, contact Terry at support@thedanielcode.com. For those of you, oh, Vicky says nicely. This is nice. Vicky, thank you. I didn't say hello to you earlier because you weren't with us, but we have another lady with us. And as you know, guys, I'm always very appreciative to have ladies. We don't have enough of them. And Vicky says, it's your show, John. Ramble as much as you like. Well, I hope I'm getting the message across to you, Vicky. It's time to be nimble. It's time to be thoughtful. It's time to cut down your exposure to long-term instruments that may not be as liquid as you hope. And in those of you who are really new to trading, if you haven't already had a trial of Trade Navigator or using Trade Navigator, Terry can arrange a free trial of that for you as well. Here's our compliance certificate. I do always want to show you that because trading, like all forms of investment, is risky. And if you don't know how to trade, it's very risky. If you're a Daniel Code tutorial person, it doesn't apply to you so much because you are learning how to trade properly. Okay, let's get out of this and go on to our charts. This is gold, incidentally. This is gold for Kurt and the guys, and lots of people who are interested in gold. Let's see, where's my friend here? Lots of people have come in late today. If I haven't already welcomed you folks, you're very welcome to be with us. Lovely to have you. Harold, the Gold King of Reading. So let's look at gold. What's gold been doing? Gold's just been going sideways now since a long time, really. It's been in this range between Daniel Code support and resistance, 1372 down to 1088. That's held this range on a closing basis now since, whoa, look here, way back here, since September 2013. But I want to show you something really interesting. Gold is very often inversely correlated with the US dollar index. And these little squiggles at the bottom are the US dollar index. So let me bring that up for you so you can actually see it. Let's make it nice and big for you. And now you can see this chart on the top is gold, and this chart under at the bottom pane is the US dollar index. And have a look at this correlation. Here's the high in gold. This is the 2011 September high. Look down to the chart below. That's an important low. From there, this market goes sideways to up. Eventually, it makes one high right here in April 2015, and another high a couple of months later. This is December 2015. This is the low in gold. US dollar index then weakens, and it weakens all the way down to June 2016. Gold continues going up for one more month. Remember, this is a 24-day chart, 22 trading days in a month. It's a Daniel Code time chart. So with only 1 month variance, gold makes its next high when the US dollar index makes its next low. Move on. What happens here? Gold's at a low, US dollar index is a high. The interesting thing to note here is that gold has not weakened nearly as much as the US dollar index has strengthened. Take this run from here. This is the high, and this is the all-time high in gold. And you can see from here on, the US dollar index, it strengthens very considerably. Look, it's taken out this high here back in July 2010 and this high here in April 2009. Gold's done nothing like that. Gold is inherently stronger than the inverse correlation. Now, correlation is not causation. It doesn't mean one actually causes the other. But it's an interesting observation that when you look at a long-term chart, this relationship's been very, very static all the way since May 2011. So you have to at least give that credence. So as the US dollar index is weakening again, gold is strengthening, but this time it's not strengthening as much as I would have expected. Okay, but keep an eye on that correlation because until it breaks, it's still a powerful pull and push situation, and I wanted you to see that. Let's move on to the other things I wanted to show you. This is the somewhere here. Let's have a look. This is the VIX. Look at this VIX. This is the volatility index. I'll just close this one off. It doesn't matter for this purpose. Have a look at this. This is the volatility index. This is all the way back to 2008, 2009. It's so low. There's no volatility. This is so-called VIX index, sometimes referred to as the fear index. There just isn't any. This is an extraordinarily complacent market. And this is the next chart I want to show you, which is very important. This is the CRB index, folks. This is an index put together by Reuters, Thomson Reuters. It's called the Thomson Reuters Jefferies CRB index. It's the core commodity index. It's changed a bit over the years. It all started back in 1957. It's changed over the years, and it's now made up of a large part of its energy products, petroleum assets. They're set at 33% of this index. So you can see the reduction in the oil price has natural gas had a big effect here. But it's also made up of other liquid assets. And interesting thing to us is commodities. This comprises 19 commodities: aluminium, cocoa, coffee, copper, corn, cotton, crude oil, gold, heating oil, on and on, orange juice, silver, soybean, sugar. And you can see that this commodity index is very, very weak. This is a really broad measure. This gives you a really good feel of what's happening in the overall commodities market, and they're weak. Why are they weak? Well, the basic proposition tells you that supply is exceeding demand. Okay, and that's basically the issue almost everywhere in the world. Supply has been, in this last 10 or 12 years, the enormous surge in liquidity provided by central banks has enabled supply in everything from manufacturing in China, in Asia, to agriculture all over the world to expand so much. We're now getting really depressed commodity prices. These prices have been hanging around these levels now for since about 2.5 years, with no sign of recovery there. And you wonder, if the stock market starts to roll over, what takes up the slack? Well, commodities is not one of them on this chart, at least. Let's move on from that and show you the other things that I think should be front of mind for you. This is a 24-day chart. This is a really, really slow long-term chart. I want you to have a look at this Forex pair here. This is the Aussie dollar against the US dollar. You've heard of me speak about this before during the mining boom in Australia, 2011. This was up over $1 US, worth more than the US dollar index. Hard to think of anything more stupid that there possibly could be. But this market's been supported at around this 74-75 cents level now for well over a year. This is a number that the Australian Reserve Bank, the equivalent of the US Fed, has been jawboning about, a level at which it's comfortable. I think this is a really crazy currency. I think we're going to have to see 67 at least before there's any reasonable rebound in this, and we have potential for it to go much, much lower. This is a market that I won't say I'm bearish, because I'm neither bullish nor bearish on anything. What we do is we trade futures contracts, and we simply take the signals. They're completely mechanical, our trading signals, and we're 1 to 7 or 8 day traders. We don't have a long-term view. And the best thing to remember is be neither a bear or a bull. Simply trade your signals. We're not in the business of being right. We're not prognosticators. We're in the business of making money. Brings me to a point that Albert raised here. Is Frank's forecast for the NASDAQ still in effect? In general terms, Frank, my guess is he thinks it's very overvalued. He had some time cycles there that could have signaled a turn, but as you'll see on our fourth seal page, we always caution people the time cycles themselves are just another form of support and resistance. This idea, Akhtar's raised it here on the side, are we any closer to 2008 Lehman type collapse? Remember the Shanghai stock market was also in a bubble in 2008. Look, we could well be, Akhtar, but I'm going to show you some more charts about that. If the market's going to have a substantial pullback, it's not going to be what you think. There's not going to be some great flash crash that drives these markets down hundreds, if not thousands of points. That's over. The central banks and the big institutions are too controlled for that now. There is a huge degree of market manipulation involved in important modern markets. That's the reality. You can read about the plunge protection team, and if you're a bear, you can be pissed off about it. And same with gold. The gold bugs are always thinking the central banks are depressing the price of gold, and if you're a bull of the gold market, you can be annoyed about that too. But the reality is that all markets are manipulated to some degree, and the really important equity markets are no different. There is a fair degree of support in there. And if these markets are going to correct, they'll do it in a very orderly manner. And it takes time, much more time than you can possibly imagine, as I'm going to show you. So that was a chart I wanted to show you. The Aussie dollar I've shown you. Gold I've shown you. And let's have a look now at the S&P, which is the broadest of these indices. That's why I use it. You can get a very wrong opinion just from the NASDAQ or the Russell. This is the broadest index you can find. This has, 500 stocks in it. You've all seen this chart before. We said that some time ago that we expected this market to be at 2,400 or thereabouts by the end of May. This bar that I have the cursor on ended on May the 8th, so I guess that's, what do they say, close enough for government business. Pretty good. We were the first to come out with that 2400s I've talked to you about before, so that was a nice target. So what happens now? Well, this market's still at risk. What's setting up there now is a potential for a false break. If that's not the case, then it will go on trundling up, ticking off these other numbers, the next one of which is 2482. But what I want to do is show you how these markets fail, because this is the sort of questions, Akhtar, you've asked, and also Albert's asked. Let's have a look at this. This is the S&P, and this is the 2000 top here, folks. This is the .com bubble, and look what happens. There's the top. This is April 2000. We move along here. We're all the way through now to September. Nothing much has happened. A couple of down bars, another down bar, a little inside bar here. Okay, when do you start to get this momentum? You get it when the old low is broken. This is a significant low. This is an important low. And for the really, really slow long-term institutional traders, that's where the stops are, underneath this low. When that's taken out, this market accelerates to the downside. 2 bars up, down it goes. It keeps breaking these all the way down. Let's move on. This one over here, this is the 2007 high. I want you to notice the same thing. Okay. This is the momentum high here. This is actually July 2007. 1 bar down, inside bar, little false break. Okay, fast moves come from false breaks. And look, here's your 2 lows before it. This is one, this is the other. When does this start to accelerate? This is just held up here near these highs. This date of the momentum high is July 2007. We're all the way through here to October. It's made a new high. It set up the potential for a false break where it just takes out the high and has no momentum on it. Little correction, little correction. Look what happens when it starts breaking the old lows. That's when you start to get momentum. Then there's a correction, a rally, 1 bar up, 2 bars if you like, and that's it. Then the real speed comes into this. So if this market is going to collapse, which I don't think it is, but we're certainly miles overdue for a correction, and we really need a decent correction, what's it going to look like? Well, this right now has the potential to be a false break, but you're talking about months and months and months, and where is the long-term signal? This is the last swing low on a 24-day chart. It's really slow. It's a long way away. That's down at 2,083. That's over 400 points away. But it's going to need a break of that low, ACTAR, or it creates its own internal low and then breaks it. So if we are going to see a 2007, 2009 type collapse, that's the pattern it's going to take. And where's it going to go to? Well, I can tell you, I'll scare the pants off you, that if that is the high, the minimum target for a correction is right here, 1548. And that would just be a standard correction on the long-term chart. I don't see that we are likely, the probability is not there for us to get any more than the correction. It's likely to be a less dramatic correction, but last a lot longer. In other words, these are slow-moving charts. So be alert, be aware of your exposure to longer-term assets, particularly assets that are not terribly liquid. And try to figure your affairs so that your destiny is in your own hands. If you've got your money with other people to manage, you don't have control over your own destiny. Okay, so there is about all I have to say to you today, folks. Unless there are any questions, I think I've answered most of them. Yeah, I sure have. And it's been great to have you with us, folks. That's it. It's Friday down under here on a sunny day, so I've just about finished for the week, but it's been great to have you with us. Mr. Nguyen's with us. He's a new arrival that just turned up a bit late today. Great to have you with us, my friend. And all of you, I really appreciate you being with me. I hope you're enjoying these webinars. Do feel free, folks, to shoot me a line, jneedham@thedanielcode.com. If there is anything in particular you'd like me to talk about, thank you, William Ford, shoot me a line about anything you're particularly interested in, and I'll make sure I cover it at the next tutorial. Okay, so thanks for being with us, folks, and Mr. MSN USE, thanks. I'm glad you enjoyed it, mate. And I'll see you in a fortnight's time, if not before. If we get any big drama, I will put on a webinar at short notice. But just follow the Daniel Code trading signals. Let's have a look at this while we're here. Just so you folks know, I am neither a bear nor a bull. I wanted to show you our trading in the Russell recently. As you can see, this is the Russell 2000 futures contract since April this year. And you can see, for those of you who are doing tutorials and using time signals, these time signals are revolutionizing trading. They're quite extraordinary. This is what I teach in tutorials. And you can see very simply here every buy and every sell that we've had on a time signal since April 2017. Have a look at this last low over here, folks. This is Wednesday's low here. It didn't go to a Daniel Code number, but I'll set you all the challenge, those of you who've done a tutorial. That low was exactly on a fourth seal low and a fifth seal low, and it was a moonbeam. Okay, so if you didn't know about that and you're doing a tutorial, shoot me a line and we'll make sure we go through it, or at the next refresher, which we'll be running next week. Get all of you up to date, those of you who are doing these tutorials. But you have a look at this, every buy and every sell signal. There has not been a single mistake in recent times using the time signals. Now, let me be clear about that. There are a couple of times in here This is a buy signal. This is a sell signal, which is not actually elected until this outside bar or this next bar, depending whether you're trading the inside bar or the bar before it. Those are cases where we say, I was right and I lost money. Okay? That's part of trading. That's a cost of doing business. I was right and I lost money. I had the signal. I took the signal. I expected the market to go up. It went up. But there wasn't enough volatility for it to clear away to give me a profitable close. And that's why we have these various types of stop loss. Remember, if we're trading against the trend, it's entirely valid to use a trailing stop loss. I'm going to talk much more to the tutorial folks about that in the coming week. But the challenge for you tutorial folks is work out for yourselves why Wednesday's low stopped at a place that wasn't a Daniel code number. Now, having said that, have a look at this. This number here, this is Monday. That close is target recognition. Look what happens on Tuesday. The low is target recognition. That low is 1367.8. The number there is 1370.9. Have a look where the close is. 1370.9, the close. Sorry, the number we were looking for is 1368.2. That low was 1367.8, 4 ticks away. Look where the close was, 1371.1 against 1370.9, 2 ticks away. Both of those bars gave you target recognition. Okay, when that happens, a breakthrough and a turn not at target recognition is not uncommon. That's why the TO3 signals are valid for 2 days. But you should be able to locate this low of Wednesday with a 4th seal line and a 5th seal line and a moonbeam. And if not, I'll be talking to you about that this week. Okay, Michael, you need to do a refresher of the tutorial, which you've already done a tutorial. We have a discounted rate for people who've done tutorials if you want to do the latest tutorial, which is all about trading time signals. Shoot me an email if you're interested, my friend. And of course, we had a buy signal for Thursday, didn't we? So we're certainly not bearish. Neither a bear nor a bull bee. Just follow your Daniel code signals, folks. You'll make all the money in the world. God bless you. Okay, I had one other chart I want to show you. It's not quite as dramatic. But there's been some confusion. This is the Aussie US dollar trading this week. And I want to a couple people sent me a question about did we get the sell on today, Thursday, the last day of trading? Yes, we did. Nice little sell, $400 or $500 per one contract. Why was that a plus sell? Have a look at this bar here, 0525 2017. That bar actually gives you a high probability that this market has made a trend change. Akhtar, this is what you were talking about. You need to be able to identify these bars that create the high probability of a trend change. Remember, there is no certainty in trading as in the same way as there is no certainty in life. Everything we do in trading is based on probabilities. But if you could identify this as a probable change of trend, then this bar here, this up bar, this outside bar, becomes one bar up, and then we had another time signal at the close of that bar. By the end of trading on Tuesday, we had a sell signal, which was not elected. Here it is the next day, Wednesday, and that signal was elected as a plus sell signal today. So that's how that works. We can be long one day and short the other, and that's part of what we do. We trade 1 to 8 days, and that's about it. Rob, thanks for your comments, old mate. Say hello to the Queen on the long weekend next week in Aussie. Yeah, thanks for entertainment. It's so lovely. He will email you an interesting chart. I look forward to that, Rob. I'm going to be in New Zealand in the next couple of months. I'm actually going to be in Auckland and Wellington, so I'll give you a bell because we're long overdue for a decent bucket of beer, my friend. Okay, folks, thank you for being with us, and I hope you've enjoyed the webinar. I'll see you in 2 weeks, if not before. Bye-bye for now. Pete, yes, Auckland or Wellington. I'll be over there in a couple of months. Thanks, folks. Bye-bye now.